Bloomberg Technology. I'm Taylor Riggs. I'm in for Emily Chang. A lot going on for you, at least within the markets, that is for sure. U.S. stocks gaining throughout the session is signs that the world could be closer to an effective treatment for COVID-19, and it's really blunting concerns, even as a number of rising cases are rising. Analysts thinking, though, it may not stent this economic recovery. For more, I want to get right to it and bring in Bloomberg's Abigail Doolittle, who has been all over the story for us. Abigail, I think if I'm correct, the Nasdaq at another record high today. What are you hearing about sort of the strength that we saw really into the end of today's session?
It's pretty amazing. We do have another record high for the Nasdaq 100, the New York FANG index. So those big tech stocks, those mega cap stocks, really continuing to do well. Of course, those are the stay-at-home stocks, this year's defense. So there's an odd tension in the fact that you have this year's defense, the new defense, hitting record high after record high. But that is indeed what happened today. Also making it interesting, Taylor, is earlier today, you actually had tech slightly lower. So at the end of the day, the bulls really rushed through supporting technology. And it suggests that investors right now are really looking past these virus numbers and the idea that it's not going to slow the economy in the way that it had on the shutdown. What's interesting about this, it sort of reminds me of back in February when the virus was raging in China. That economy effectively shut down. Stocks here ignoring it. It feels as though we are ignoring perhaps some of this fundamental data. But nonetheless, take a look at these moves that we have on the day. And it wasn't just tech, though, because tech actually on the day slightly lower as a sector. Those mega caps, which aren't necessarily technology stocks, were the ones that were flying high. But the financials, the best sector on the day, up 3.5%. So a bit of a nice cyclical tilt there for the S&P 500, being helped out by bonds falling. So that's risk on. It was a risk on day at the end of the day with yields rising. But to the point of tech stocks, or excuse me, I should say in this case, consumer discretionary and services, communication services, Netflix on the week, because we did have an up week for stocks, even though we had a couple bumpy days. Take a look at that. Netflix up 15% today, rising about 8%. This is Goldman Sachs raised their price target to a street high of $670 per share. They're expecting their second quarter to be a blowout, adding at least 12.5 million subscribers on content, not even the stay-at-home theme. So it's going to be very interesting. A lot of eggs in this basket, Taylor, and this upcoming earnings season that really starts next week with some of the big banks, along with PepsiCo, is really going to be a big tell on whether or not investors have it right.
And Abigail, push it forward to us as you take a look at that. You mentioned Netflix, one of the bigger gainers in the last 5 days. It looks eerily similar to the Nasdaq 100, which continues to push higher. The strength of some of the big cap, big tech names here. Are there any concerns, perhaps, that it could be oversold at this point, given the massive run-up? You know, one concern, Taylor, is we have a really big divergence on the year, one that a lot of people are talking about. So on the year, the Nasdaq 100, those record highs, up about 24% on the year. The S&P 500 down slightly, down about 2%, but down rather sharply is the S&P 500 equal weight. So in a way, if you were to take a look at the S&P 500 without that mega cap influence, we actually have that almost in correction territory. It is actually in correction territory on the year. So that could be a real issue. It really speaks to the story of the haves and the have-nots relative to companies. You just have to hope that the have-nots are going to improve their fundamental picture. Otherwise, it could really weigh on the markets overall. And to the point of the Nasdaq 100, talking about putting all the eggs in one basket, this is the percentage of, these are the top percentage performers relative to the Nasdaq 100's performance this year. Amazon, 25%, Microsoft, 16%, Apple, 15%, Tesla, which is now up about 300% year to date. Not quite, but, it's hard to see how that's a stay-at-home stock, but nonetheless, huge momentum there, about a 10% weighting there. So about 65% of this year's Nasdaq 100's performance, those four stocks alone. Not a lot of diversification there, to say the least, Taylor. Well, thank you, as always, there to Bloomberg's Abigail Doolittle. And we will stay on Tesla just a little bit because we are hearing now Elon Musk has passed Warren Buffett on the billionaires ranking. You can thank that probably in part to the massive run-up that you've seen in the shares of Tesla, and other headlines crossing as well. Amazon is saying that it sent its delete TikTok email in error. Remember, earlier we reported that some employees, we believe, had received an email from Amazon requesting that they delete TikTok from their devices. Amazon now saying that that email to delete TikTok from your devices was sent in error. And it's almost as if we planned it, because we have a man here who's been covering Amazon. He covers Facebook. He covers all of these big tech stocks. That is with Michael Levine of Pivotal Research. Michael, it's always great to have you on the program here. Let me start, if you can, on Amazon. I know that you don't cover TikTok. What do you make here of some of the competing interests that you see? Amazon now saying they didn't mean to send the email with TikTok. Are there any takeaways here from Amazon, or am I reading too much into it?
You may be reading too much into it. I mean, it sort of feels like something that wouldn't exactly be party line. But I mean, just given the general rhetoric coming out of the Trump administration, it wouldn't surprise me for them to come down and lower the boom on TikTok. I mean, there's certainly a lot of mistrust at this point, and I know with them bringing in new leadership from Disney, I know that they're talking about wanting to move away, and we do definitely have been doing a lot of work around TikTok. It's perceived as being a potential threat, definitely the time spent for YouTube, for Instagram, and occasionally for Snapchat, but unclear. I mean, you're still owned by ByteDance, and I definitely understand the basis that the government could make for the security concerns.
Well, I'm glad that you're keeping me honest here when I'm reading into too much. I want to talk, though, more generally about Amazon. We were talking with Abigail in the segment just right before you, talking about the RSI index. Amazon looking so oversold on many levels. How are you thinking about Amazon generally in this environment? How much more room, perhaps, the company has to grow as they increasingly just become more and more dominant?
We had a piece out earlier in the week talking about retail and e-commerce, and sort of specifically digging into the Pivotal Advertising Insights panel. And the majority of folks basically thought, and this has continued to uptick even as the country's reopened, there's been a question mark of, let's just say we were at 12% e-commerce penetration in the States, more or less. During COVID, jumped up to 25. It's like, where do we land? Does it basically go back to 12? Does it stay at 25? It's likely somewhere in between. But the important part to your question, Taylor, is I think we've plateaued at a much higher rate than we did basically going into the virus. So, I think the interesting thing with Amazon is they've sort of been given this shock test, given just really unprecedented levels of demand. I mean, above what they would have seen during a holiday season. So I think you're going to see them come out with such a profound lead versus any of their peers with regards to logistics. So I think this, if anything, has actually more meaningfully solidified the moats for the business.
Michael, how are you thinking about Facebook in this context, not only with the strength that you've really highlighted in advertising, but then, of course, news today that they're thinking, just to get out of all the controversy, of potentially pulling all of the political ads. We know that political ads aren't a huge part of their revenue. Could that be a pro, then, for the company just to get out entirely?
I think it could. I mean, it's like and look, it's one of these things where brand advertisers in terms of who conceivably would be even in a position to boycott Facebook, we're probably talking about 5 to 7% of their annualized revenue at baseline. But I think you're risking basically becoming a lightning rod, which I think is what's happened and sort of driven you to this place. So I know Mark Zuckerberg had been out, had said this is less than, I think, either 0.6 or 0.5% of their annualized revenue. So from my perspective, I'm like, just don't deal with the agita. It's really, really not worth the distraction. There's enough other good things going on at the company. I mean, it's a good way to take the high ground.
And what are some of those other things at the company? You've been talking a lot about Facebook Shops, some of the social commerce.
Yeah, I mean, that's been one of our been one of our really big themes. I mean, what really first turned our heads was when Google basically announced, and this is really under new leadership at Google, the free, basically the free product listing ads would initially be incorporated within the shopping tab, was followed by Facebook doing really I wouldn't say a 180, but certainly a healthy 90-degree turn, where they initially had talked about trying to get shopping going, we're trying to go it alone, and then really went ahead, made a pivot, and said, like, look, we're going to embrace partners like BigCommerce and Shopify, and recognize, look, we're not going to be able to bring the entire thing soup to nuts. So what the way I guess we've been framing for it with investors is we're sort of looking at this inflection point that I think COVID has really brought to the forefront of the retailization of, or let me rephrase it, productization of commerce and retail ads. So I think you're just going to see more ads that are going to have actual commerce capability embedded within them. And look, Facebook is absolutely enormous. So I'd say even if you don't see their being successful as a destination, like I'm not as convinced that happens. If you actually have this happen in terms of adoption by the ad base, I think it's a huge upside for the business.
Michael Levine there of Pivotal Research. Thank you, as always, for talking about those trends and also taking on some of that daily news of the day that we're bringing you. Thank you. And to stay with us, because coming up, America's largest rooftop solar company, it's SunRun, becomes even bigger. It has a deal with rival Vivint Solar. We will hear all of the details from SunRun CFO. All of that coming up next. This is Bloomberg. SunRun is set to become a behemoth in the American rooftop solar market. This is all through about a $1.5 billion takeover of its rival, Vivint Solar. Both companies provide about 75% of new residential solar leases each quarter here in the U.S. To discuss what this deal means for consumers and the solar energy sector, we are joined now by SunRun CFO. It's Tom von Reichbauer. Tom, great to have you on the program. Talk to me about what this deal means to you, really, in terms of size and scope and scale to get you to where you want to be.
Thanks for having me, Taylor. It's great to be here. SunRun's mission is to create a planet run by the sun. We want to bring clean, affordable, more reliable power to consumers all over the country. This transaction helps us get to a new level of scale where we can reach more customers and solve a really important problem that's even more pressing today. Customers want more choice in their energy consumption. They're facing increasing electricity prices, and as they spend more time at home, we're seeing increased energy consumption. And so there's just more demand for the product, and it really is the right moment to bring these companies together.
There's been some concern as well that there's a solar race going on with Tesla as well. They, as you know, have been in this game as well. They purchased Solar City back in 2016. How do you feel you're positioned relative to some of the competitors in this space?
Yeah, we're really excited about where this transaction sets us up to reach a new level of scale. 500,000 customers operating in 23 states with nearly 9,000 employees. And we think the combination helps us deliver on efficiencies that'll enable us to bring more products and more affordable solutions to customers at an even faster pace through combining our R&D efforts. We have a lot of respect for Tesla, a highly respected company. They make one of the best home batteries in the market, which we're proud to offer to our consumers. And we think competition's good. This is an industry with more than 5,000 companies across the country, with more than 1,000 in the state of California alone. And so, we think there's a lot of opportunity out there for many people to participate in this.
Tom, it's interesting. Since the market bottomed out on March 23rd, your shares are up 200%. And before the deal was announced, you were still up more than 100%. That's versus the rest of the market, which was only up about 40% or so. I'm curious if the gains that you've made since the bottoming out on March 23rd, how much of that has to do with increased demand that you're seeing in this COVID area? We're all working from home, so we have a more special attention, if you will, to our home environment, perhaps wanting to improve the value of our home since we're spending a lot of time here. Are you seeing increased demand as more and more people are spending more time at home?
We're definitely seeing some benefits from that. The Department of Energy last week said that electricity bills are going to be up nearly 25% on average this year as consumers are spending more time at home. We took a number of actions in late March and early April to really position us to move through this potentially prolonged crisis quite well. We moved to a fully virtual selling model, selling over the video and over the phone. We deployed drones for our pre-construction audits at customers' homes, and we employed the best practices for employee and customer safety as we go out and actually do solar installations. I think it's worth noting, too, that residential solar and home battery installation was deemed an essential service in most of the country. That speaks to the pressing need for a modern energy grid, and these investments were really critical. And so we've been able to weather through that quite well. We're seeing places open back up, and that's been very helpful as we move forward. It also helps that we came into the situation, I think, very well positioned. The SunRun team has built an amazing business over the last 12 plus years. We had strong cash flow generation last year, and so we were well positioned to be agile and adapt to the environment.
How does a potential Biden win in November change the game for you, whether it's subsidies that come back to help boost the business? How are you thinking about your business come November and a new Congress that could come into play here?
The great thing about this is the need to bring a modern energy infrastructure and more affordable, clean energy to consumers is a thing that both sides of the aisle are really excited about. There have been proposals floated from both parties around extending tax credits and the like, and we welcome some of those extensions. They've been great benefits for the industry in terms of driving job creation. More than 250,000 people work in residential solar in the U.S. today. It's one of the fastest growing job sectors. It's been effective at increasing investment to drive costs down and make these products more affordable for consumers. And so we really think that this is a nonpartisan issue and one that most of America is excited about.
And Tom, if the acquisition goes through, you will have significant market share within the residential space. Talk to me about future growth areas. If there are conversations to talk into paneling corporations, as perhaps corporations are now thinking to themselves, we want to be carbon neutral. How do we do that? How do we play a role in getting the environmental goals, perhaps, and taking a role in that? What are some of those future growth opportunities? What do they look like to you?
Yeah. So a couple things that I'd touch on there. First, it's worth noting, as I mentioned earlier, that there's more than 5,000 companies in this space. We'll be a good size player, but this is a highly distributed industry. And so, I think there's a lot of competition to go around. A really exciting opportunity on the horizon here is our partnership work with utilities in building out virtual power plants. The job that historically has been fulfilled by expensive, polluting, large industrial machines could one day be replaced by a network system of residential solar and home batteries. You can imagine us, dispatching energy to the grid or to our neighbors in ways that help make the system cleaner and more reliable. It's also inherently local, which reduces some of the really expensive infrastructure investments in cross-country transmission. We've deployed assets like this with a number of partners, including in Massachusetts, and we've announced partnerships all across the country, from Hawaii to California to New York and all of New England.
SunRun CFO Tom von Reichbauer, thank you for joining us, giving us your perspective. And coming up, Wall Street gets the flag, but it's really these tech CEOs that are getting paid all the big money. We discuss all those big paydays. That's next. This is Bloomberg. Wall Street's getting all the flack, but then it's really all these tech CEOs who are getting paid all the money. If you take a look around at corporate America these days, you will find any number of executives, particularly in tech, taking home far more than those bankers ever made. To discuss, we're joined by Bloomberg's Andrew Mellon. Anders, it's funny, right before your segment, we got a headline crossing the terminal saying that Elon Musk has rocketed past Warren Buffett on the Bloomberg Billionaires Ranking Index. I guess this sort of furthers your point, right?
Yeah, not a bad day to be Elon Musk, I guess. But yeah, you're absolutely right. It's funny how when you listen to lawmakers and even on social media, you oftentimes see the bashing of bank CEOs and hedge fund managers and private equity titans and so on. But I mean, there are people in many other industries that have been surpassing them in terms of compensation for years, and tech really stands out in that aspect.
In your opinion, why aren't tech CEOs getting the sort of heat that bankers made? I'm wondering if there is a difference in the composition of how they're paid. Maybe it's through stock and less cash that perhaps is leaving them off the hook a little bit.
Yeah, I think it's a combination of factors. I mean, for one, 10 years ago during the financial crisis, the banks played a very central role there, and many CEOs were accused of essentially playing with fire and almost taking down the global financial system. None of the tech companies have been accused of something to that effect yet, although some would argue that Facebook, the role of Facebook has been quite impactful on global politics over the past few years. But I think a lot of it just has to do with the idea that tech is kind of draws the benefit of having this aura of, it's startup, it's hip, it's cool, we're creating new things, and people make a lot of money if it's successful. And while that's true, many of these companies whose CEOs we see on this list, like Amazon, Alphabet, Microsoft, Intel, Apple, I mean, these are really large, mature companies now. They are worth a lot. They employ tens of thousands of people. But they still draw the benefit of this, like I said, aura of startups and the risk-taking and the money that can come with big wins.
Anders, where does female compensation fit into this narrative?
So among the 100 top-paid executives in the U.S. last year, there are 4 women, so not many at all. The first one comes on 19th place. It's Lisa Su, who's the CEO of Advanced Micro Devices. So it's really an overrepresentation of men, but in many ways it kind of mirrors the prevalence of women in CEO jobs in public companies in the United States. So they are few and far in between, and I guess it's kind of a reflection of what executive suites look like in corporate America at this point in time.
Anders Mellon of Bloomberg News, thank you as always for bringing us that perspective. And coming up, Facebook continues to be embroiled in heightened criticism and controversy over its content policies. We'll have an overview of all of that next. This is Bloomberg. This is Bloomberg Technology. I'm Taylor Riggs. I'm in for Emily Chang. Bloomberg has learned now that Facebook is considering a ban of its political ads on its platform in the days leading up to the U.S. November election. For more, we're joined here by David Kirkpatrick. He's the founder of Techonomy and the author of The Facebook Effect. David, I love days like this when we have you on the program and then you get news like this just in the last few hours about Facebook considering just taking off political ads altogether. What do you make of that?
Well, thanks, Taylor. Well, first of all, it's good to remember this is something Twitter already did last year. But I think it's in line with the way Facebook's been acting lately in this sense, if they were to do it. So many of the things they've done in recent months seem to be engineered not to offend President Trump. And yet they're under this extraordinary pressure from the ad boycott and the human rights audit that found them wanting, which was released this week. So if they were to ban all political ads, they could say they're doing something. They could say they're responding to the pressure. But they also could say, this is not anything about Trump. This is about all politicians. So they could sort of get away from the risk that he would single them out and say, you're treating me unfairly, which they seem congenitally incapable of bearing. So I think it's not an unreasonable possibility that this could really happen.
David, you mentioned that they're following what other social media companies like Twitter, for example, already put in place. Does it make you nervous that you have a company like Facebook with 2.6 billion monthly active users, 1.7 billion daily active users, and instead of providing leadership, they're taking cues from other smaller social media companies, perhaps is a more reactive stance instead of taking on a proactive initiation here?
Well, you said that very well, Taylor. But it's not exactly that they're taking their cues from Twitter that concerns me as much as just the sheer fact that they're so big. I mean, they are just too big for us to really tolerate. That's one of the weird kind of dilemmas that Facebook poses to society. Their influence is so vast. And it leads to a lot of strange contradictions. You know, I think one of the reasons that Zuckerberg has taken such a peculiar set of attitudes about speech, hate speech, and political speech inside Facebook is that, in a sense, he feels he is the government because his company is so much the central platform for political speech in not just the United States, but all over the world. And, you know, he has said he wants regulation. And to be honest, until we get regulation, we are going to be in a very uncomfortable, very awkward situation vis-a-vis Facebook, society, and democracy, because we have to have rules for the road, and the company clearly seems incapable of establishing them for itself.
I want to rewind a few weeks and take our viewers and our audience back to the boycott, really, that was launched to stop posting ads on Facebook. Now, it's just for the month of July, I believe. But, David, is that enough, really, to catch people's attention?
Well, it has caught people's attention. I mean, the fact that, 400 large advertisers and by some counts as many as 1,000 advertisers have basically suspended ads on Facebook either for the month of July or indefinitely, and some of them have suspended ads on Twitter and YouTube as well, and all social media in some cases. I think that's been a very important symbolic and PR issue. I think it has pressured Facebook to respond because Facebook is a very, very, very image-conscious organization. They are desperate to be seen as doing the right thing. They are desperate to be liked. And even though the boycott, despite the fact that big advertisers like Unilever or Coke have joined the boycott, it isn't going to really have a material financial impact on them because their revenues are so overwhelmingly coming from small advertisers, local mom and pop stores.
Yeah.
But the pressure has been real. It's led to some real concrete discussions between Facebook and the human rights organizations like the NAACP and Color of Change and Anti-Defamation League that have been organizing the boycott, and I think it's a positive thing for progress.
David, talk to me more about that, because I spoke with the head of the Anti-Defamation League earlier this week. He and a few other civil liberties leaders came out of the meeting with Mark Zuckerberg this week, frankly, unimpressed with the way conversations had gone. What real change do you want to see, that you should see enacted by Facebook to really address some of the biggest concerns that we're hearing from these organizations?
Well, there's a whole range of things that the organizations that have organized the boycott want. If I was to pick one thing, though, and I think this is almost universally agreed to be the one thing that they need to change the most, that is the policy that they have tenaciously clung to and that Zuckerberg has repeatedly defended to allow politicians to lie in paid ads on the service. That is an outrageous policy that both the human rights organizations and the ex-employees who wrote a letter to Zuckerberg recently both pointed out that it's inverting the whole history and purpose of Facebook, which was intended originally to be a place to give ordinary people a voice. Now, basically, they fact-check lies if it's said by, in hate by an ordinary person. But if a politician says it, they can get away with it. So it's sort of like saying the powerful have rights that ordinary people do not have. That is just plain wrong, and it's illogical. And frankly, I'm befuddled why Zuckerberg is so attached to that policy. If he changed that, I think he would get a lot of heat removed from him. The problem is it would anger the president, because it is many of the president's allies and the president himself in some cases that utter untruths, sometimes put them in their ads. And Facebook, like I said at the beginning, is just unwilling to risk angering the president.
Well, our thank you as always to that analysis. That is David Kirkpatrick, founder of Techonomy Media and author of The Facebook Effect. And coming up, one of the more interesting developments from the coronavirus lockdown has been an unprecedented number of new retail investors entering the investing game. We will have more on the rise in retail and those broader markets with the founder of Interactive Brokers Group. All of that next. This is Bloomberg. Some are calling it the Robinhood effect. Retail investors have flooded the market in recent months, all as stocks have rebounded. Now evidence is starting to build that their buying has become one of the key drivers of some of the beaten down shares that are dominating the rally. Sonali Basak is our Bloomberg Wall Street correspondent. She's standing by with a veteran market maker. Sonali, take it away.
Thank you, Taylor. With me, I have Thomas Petterfy, who is the chairman and founder of Interactive Brokers, really a pioneer here in online trading. Thomas, tell me what you think about retail trading becoming a more significant force in the markets moving forward. Do you think there could be enough interest to really drive markets?
So I think that this phenomenon should be looked at as a sudden spurt in a otherwise existing very, very long-term trend. Namely, the stock and commodities exchanges became computerized towards the end of the last century, which enabled the emergence of online brokers and the computerized processing of custodial and back office functions. Now, that in turn enabled online brokers to offer direct access to their customers at extremely low cost and very low latency. So this process has been going on gradually for about 40 years, and now with the coronavirus, this suddenly picked up speed. So after I think the virus will eventually, or rather soon, I think will the fear will disappear, and I think that the trading volumes will subside, but will not go back all the way to the levels where they used to be, because many people during these 4-month periods have opened accounts, learn about investing and trading, and so those people's activities will remain.
Mr. Petterfy, then what does that mean? Who are the people that are really entering this market? Are they much younger people, and do they have the resources they need to be trading this market?
So, well, our customers tend to be the more sophisticated type. They tend to be in their mid-40s. Yes, they certainly have the money and they have the education. They tend to be in the technology or financial business or in management somewhere, and they certainly know what they are doing. So all this nonsense I hear in the news that these are people who have no idea what they are doing is maybe that's true for Robinhood, but it is not. I would say it's not generally true for people in the markets, and these people are not very different than who they were a year ago.
Do you believe then, do you have any concerns then about the rise in Robinhood? How do you feel about them becoming such a big competitor in this market?
Well,
big force in this market?
Let's look at it realistically. I hear that Robinhood has 13 million accounts. So, and I also hear that the average equity in an account is somewhere between $2,000 to $4,000. So that's between $25 and $50 billion that certainly is not enough money to have a substantial impact in market prices. So I don't think that you could say that the markets are running up because Robinhood investors are buying the market. I think
But how do you feel about younger investors, the folks that are on Robinhood, taking on the type of leverage that they may be taking on, or trading with more complex securities? Do you think that the market is ready for that?
Well, the market certainly is ready for that. The question is, are they ready for it? But I don't know if that is actually true, what you're saying. I mean, we certainly do not see that happening. So, you know, I'm first of all, most brokers have a lot of educational material on their website. In our case, for example, if somebody wants to trade options, they have to apply for it, and they have to have 2 years of option trading experience. People can open demo accounts where they don't have to put down real money, and they can play around with fake money up until they really get the hang of what they are doing. And so, you know, we try to extend all the educational opportunities we possibly can.
That's a fantastic
and people
point.
who do not take advantage of that, well, that's their fault. I mean, you know, at one point, people should be old enough and serious enough to be responsible for themselves.
That's a great point. Another thing I want to look forward to is the next catalyst for the market. The elections are right around the corner. I'm wondering what you think it could mean for a Joe Biden presidency, even in the market. What would that mean for the stock market?
Yeah, well, you know, Joe Biden presidency is a big issue, and I think you know, it all depends on whether the centrist Democrats have the capability to stop the country from sliding into socialism, because if that happens, you know, then there is no private ownership of companies, there is no stock market, and there are no Bloomberg machines. So I don't think anybody would like that.
Mr. Peterfy, I hope to have you back again soon. Thank you for joining us. And Taylor, back to you.
Well, thank you there, as always, to Bloomberg's Sonali Basak. Now, tech is on a tear, with the sector remaining resilient, even as the global economy struggles against the fallout of the coronavirus pandemic. But Mike Novogratz, he's the CEO of Galaxy Investment Partners, warns that tech stocks are in a classic speculative bubble, reminiscent of cryptocurrency markets all the way back in 2017. He spoke exclusively with Sonali. Take a listen.
So this is a bubble, certainly in the tech space. I remember when Alan Greenspan issued those words. I don't think Jay Powell will be saying them, given that he wants the market higher. But, you know, we're kind of unhinged from reality in a little way here, right? The economy is grinding, slowing down. We're lurching in and out of COVID, yet the tech market makes new highs every day. Tesla's up 10%. That's a classic speculative bubble. Lots of liquidity. It's finding its way into story stocks. We're at really dangerous valuations on the growth side, right? On the tech side, it's just, you know, if it's Zoom or Tesla or Beyond Meat or whatever stock has a story, everyone's rushing into. That gets me worried.
So what does that mean for the retail investor here? We've been doing a lot of work on the mom and pop investor coming into this market. Are you concerned that they may get really burned here at some point? Oh,
yeah, certainly. This really reminds me a lot of the cryptocurrency markets in 2017, when we had this crazy rally where Bitcoin went from 8,000 to 10,000, and it was at 20,000 40 days later. And lots of people bought in, and then it collapsed. Listen, these stocks aren't like crypto. They're real companies. They're just getting valued way ahead of kind of what I think reality will be. And I do think there'll be a moment. Usually these markets, you know, what ends great bubbles usually is central bank action, or sometimes just exhaustion. In this case, we've got a big election coming up, right? Joe Biden, he wins. Let's just assume he wins for a second, because I think he will. And all of a sudden, capital gains tax are raised, corporate tax are raised, high-end income taxes raised, that won't be good for the market. And so that's not priced in yet. We're still in this euphoric stage of market going up every day, fueled by just tons of liquidity.
So I want to talk about that idea of Biden here for a second, because just yesterday he was saying that he doesn't believe that the shareholder capitalism can continue. How is Wall Street, how are investors going to bake in that thinking?
Well, listen, Wall Street was already moving that way in a lot of ways. You know, Paul Jones has a thing called Just Capital. Larry Fink is on the train, as is, you know, Mark Andreessen, and tons of people have been moving that way and saying we need multi-stakeholder capitalism, right? Just shareholder only isn't working. It's the rich-poor gap's getting too wide. It's leaving too many people behind. It's leaving the environment behind. And, you know, there's this rise in ESG funds. Almost every fund wants to be an ESG fund these days. And so I do think Biden is moving to where Wall Street, and he's going to be trying to lead Wall Street, but Wall Street was already moving there. So, that's not, I think, the concern for the market as much as the tax code.
So I want to go back for a second, because you were talking about these sky-high tech valuations. What does that mean in terms of how you're investing?
You know, a friend of mine, I said this yesterday, a friend of mine said, in markets like this, you want to be on the airplane, but be on the seat closest to the exit. The reality is I've missed this tech move. I fought it a little while. I at least got smart enough not to keep fighting it. But I haven't been participating. And so I got a lot of friends that are making a lot more money than I am these days. Listen, I have a whole bunch of gold. I have a whole bunch of Bitcoin. That's also participating in this liquidity-driven bubble. I think they'll be longer-term winners in the liquidity-driven bubble, because the liquidity will go away. But it's not catching this mania that you're seeing in these story stocks.
That was Mike Novogratz, Galaxy Investment Partners Chairman and CEO. And still ahead, Joe Biden launched his plan on Thursday to revive the U.S. economy with a promise to build back what existed before the coronavirus pandemic. Bloomberg caught up with a key advisor to the Biden campaign. That conversation is next. This is Bloomberg. Joe Biden rolling out the first part of his economic plan in a speech in Pennsylvania yesterday. One advisor to the presumptive Democratic nominee is Penny Pritzker. She's the former Commerce Secretary under President Obama. Our chief Washington correspondent, Kevin Cirilli, spoke earlier with her.
The vice president has put out a plan that I think is one that will help create greater certainty in America, which is really important. Key components of the plan are, first of all, investing in infrastructure, procurement, and R&D. $400 billion for infrastructure and procurement, and $300 billion to invest in very important areas of R&D, sectors of the economy that we as a country need to lead in: clean energy, batteries, AI, 5G. This is the largest investment in these areas since World War II.
And it's really interesting because he framed this as firstly, the response that is needed to face this moment, especially given the dynamics of COVID-19. But also he said he wanted to end the era of shareholder capitalism. Why is that important?
Well, I think what you're seeing is this country is facing really three crises: a pandemic, an economic crisis, and also we're having a national reckoning with racial inequality. And what you're seeing is the vice president saying we have to address all three of these crises simultaneously. And I think it's consistent with where American corporations are going, which is a recognition that their stakeholders are not just shareholders, but it's employees, it's customers, it's shareholders, it's the communities in which they operate. And so I think this is completely consistent with where the country is moving.
You know, I hear you talk about the need for certainty, and you're seeing, especially in the markets over the past couple of weeks, this adjustment of sorts. But it's not just on Wall Street where you're seeing this adjustment towards maybe the possibility of a Biden presidency. But why is that certainty needed as for Main Street and for small businesses as well?
Well, look, it's really hard to plan when you have absolutely no idea what are the rules going to be. Are we going to be able to have an open economy? Are we going to be a healthy nation? And so, you know, the vice president recognizes the first thing we have to do is deal with the nation's health and make sure that everyone has appropriate health care and that we beat this pandemic. But the second thing is, if I'm a small business owner, or I'm someone trying to plan to open my restaurant or open my shop on Main Street, I have no idea whether people are going to be out and about. What are the rules going to be? What do I need to do to protect my employees? How do I make my customer feel comfortable? These are the kinds of things that need to be clear, and they don't need to be something that's different from one community to the next, but rather we should have a uniform standard as to how, you know, what the behavior and what expectations are to be met.
That was former U.S. Commerce Secretary Penny Pritzker. And that does it for this edition of Bloomberg Technology. Bloomberg Technology is live streaming on Twitter. Check us out at Technology, and be sure to follow our global breaking news network at Quick Take on Twitter. This is Bloomberg.